The screen flickers, your cursor pauses over the silver charts, and suddenly you notice it. Everyone is talking about floors, $70, $100, some magic number that's supposed to hold forever. It's like the market has its own mythology, and we're all just trying to whisper the right prayers. But here's the thing. Markets aren't afraid of headlines. They shrug off debt clocks, interest rate chatter, oil spikes. What gets them moving isn't the noise. It's the quiet, the overlooked, the cracks that almost nobody talks about. Think about it for a second. The last time silver made a big run, the world was convinced it had found a bottom. Everyone nodded in unison, until it didn't. The elevator went down. No one planned the exact floor, and that's precisely the point. Right now, the chatter online, the YouTube titles screaming doom, the Reddit threads full of panic, it's all the background hum. It doesn't dictate what's next. What matters is what almost nobody sees coming. The unnoticed pressure, the subtle shifts in money flows, the invisible currents that will eventually shove the price somewhere entirely unanticipated. So, before you click another "silver is crashing" video, ask yourself, are you reacting to what's loud or what's real but quiet? The market opened Monday morning with silver at roughly $74 an ounce. By mid-afternoon, it had dipped to $71.50 before recovering slightly to $72.10 at the close. That's a swing of about 3.8% in a single day. Trading volume on the COMEX exchange was measured at 105,000 contracts, slightly above the 30-day average of 98,000. Looking at the past week, silver started at $76, dipped to $71.50 on Tuesday, rose to $73.50 on Thursday, and ended the week near $72. The intraday moves were sharpest between 10 a.m. and 2 p.m. Eastern Standard Time, when approximately 60% of daily volume was executed. Meanwhile, the U.S. dollar index, DXY, rose 0.4% over the same week, from 105.2 to 105.6. The 10-year Treasury yield increased from 4.15% to 4.22%. These movements coincided with the release of the Monthly Producer Price Index, PPI, which reported an increase of 0.3% month-over-month and 2.1% year-over-year for finished goods. In the physical market, premiums on American Silver Eagles rose slightly, moving from $2.10 over spot to $2.35, indicating steady demand. ETF holdings in SLV remain virtually unchanged, holding 420 million ounces. Compared to the previous month, the silver price is down roughly 1.5% from $73.10 to $72. The volatility, calculated as the standard deviation of daily returns over the past 30 days, is 2.7%, slightly above the historical average of 2.3% for the same period last year. No major geopolitical announcements directly affected the market during this week. No confirmed changes in monetary policy occurred. These movements reflect the combination of routine trading, positioning adjustments, and responses to published macroeconomic data. In short, silver has experienced moderate intraday swings, a small net weekly decline, steady physical and ETF demand, and slightly above average volatility. The price remains above $70, consistent with levels seen over the past month, while U.S. macro indicators show incremental changes rather than shocks. When silver moves, the impact isn't isolated. The first layer is the immediate participants, miners, refiners, and physical dealers. A drop from $74 to $72 means miners see slightly lower revenue per ounce. Refiners might adjust production schedules, moving more cautiously or storing bullion rather than selling. Dealers in the physical market, coin shops, online sellers, adjust premiums and inventory levels. That can affect retail buyers looking to stack silver, who may encounter slightly higher or lower costs depending on availability. The next layer involves financial products. ETFs like SLV hold hundreds of millions of ounces. Even small shifts in price can trigger marginal portfolio rebalancing. If multiple institutional investors execute trades simultaneously, it amplifies the effect, causing temporary spikes in intraday volatility. Futures traders on the COMEX are another layer. Open interest, leveraged positions, and stop-loss orders create a network of contingent actions. A single large liquidation can ripple through these contracts, influencing price behavior for hours or days. Then there's the macro layer. Movements in silver often coincide with subtle shifts in broader markets. A rising DXY, as observed this week, generally correlates with downward pressure on silver priced in dollars. That doesn't guarantee a fall, but it creates conditions where weaker hands, investors with short-term focus, may react, adjusting portfolios across commodities and currencies. Treasury yields, inflation indicators, and global liquidity levels interact with silver indirectly. Higher yields can make non-interest-bearing assets like silver slightly less attractive. Inflation reports can adjust expectations about future demand for tangible stores of value. Finally, the ripple reaches the end-user economy. Jewelry makers, industrial consumers of silver, and electronics manufacturers respond to changes in cost and availability. Marginal shifts in price can alter procurement timing or volume. Retail investors may adjust allocations in personal portfolios. While the dollar impact on individual purchases is small, collectively, these adjustments can subtly influence cash flow and inventory planning. In short, a change in silver's price isn't just a number. It's a chain. Miners to refiners, to dealers, to financial markets, to macroeconomic conditions, to industrial and retail end users. Each stage responds differently and at different speeds. Observing these chains provides context beyond daily price headlines. It shows that silver is embedded in a network of economic actions, and understanding these links helps separate temporary noise from structural patterns. Looking back at silver in 2011, there's a pattern worth noting. In January of that year, silver traded below $30 an ounce. Over the next 7 months, it surged above $48. That run caught widespread attention. Analysts, retail stackers, and media alike treated certain price levels, $30, $40, $45, as psychological floors. Everyone assumed a bottom had formed, but by mid-2013, silver fell below $30 again and lingered there for years. The floor had been illusory. What makes this example useful isn't the exact numbers, it's the behavior. Markets build expectations based on recent experience. Investors see a high, then a dip, then assume stability at the new low. Yet underlying dynamics, supply adjustments, macroeconomic shifts, currency movements, continue to evolve. The floor only appears solid until conditions change. Fast forward to today. Silver has hovered around $70 for several months. Some are calling it the new floor. The comparison to 2011 is obvious. A significant run, a plateau, and psychological benchmarks forming in investor minds. But there are notable differences. Global liquidity is tighter now. Central bank policies are distinct, with the Federal Reserve actively managing inflationary pressures in ways not seen in 2011. Industrial demand has shifted, particularly in electronics and solar panels, changing the composition of silver consumption. ETF ownership has grown substantially, concentrating exposure in financial markets more than in 2011. Another difference is geopolitical awareness. Back then, few retail investors considered macro credit risk, sovereign debt, or currency stress. Today, those factors are part of daily conversation. That changes behavior, particularly in high-volume retail participation. The takeaway: history offers patterns, not prophecies. The elevator metaphor from 2011, a rise, a dip, and a potential descent, illustrates human expectations more than market mechanics. Past floors and ceilings show how investor psychology interacts with real-world factors. They remind us that no price is guaranteed, and that what seems obvious today may appear quaint in hindsight. By understanding the past, viewers can filter emotion. They can recognize the tendency to treat recent highs or lows as permanent, while also noting structural differences that make today unique. Perspective, not prediction, is the goal. If industrial demand continues to rise and physical silver supply remains constrained, then prices could sustain above current levels. For instance, growth in solar panel manufacturing and electronics consumption would require consistent silver procurement. If ETF holdings stabilize or increase, reflecting investor preference for tangible assets, then market liquidity would remain supportive of higher prices. A weaker U.S. dollar combined with stable treasury yields could further enhance the appeal of silver as a non-yielding asset. Under these conditions, silver could maintain a trading range above $70 and potentially approach recent peaks observed in mid-2021 near $80 per ounce. This scenario assumes no significant macro shocks, such as abrupt monetary policy changes or geopolitical disruptions, that might force rapid liquidation or repositioning by major holders. Base case: if current conditions broadly persist, then silver is likely to fluctuate within a defined range around the $70 mark. Price movements would respond incrementally to regular macroeconomic updates, including CPI, PPI, and Treasury yield announcements. ETF positions and physical market premiums would adjust modestly, reflecting short-term supply and demand variations. In this scenario, industrial use continues steadily, retail investor participation remains cautious, and macro indicators remain within historical bounds. Volatility may remain slightly above the long-term average, around 2.5 to 3% over 30-day rolling windows, producing intermittent swings of 2 to 4% intraday without breaking structural support levels. Here, silver functions as both a store of value and a trading instrument, but no dramatic directional change occurs unless triggered by a new macro or liquidity development. Bear case: if Treasury yields rise sharply and the US dollar strengthens significantly, then silver could come under downward pressure. Additionally, if global liquidity tightens through central bank actions, margin calls, or large-scale ETF outflows, then short-term selling could push prices below $70. Industrial demand reductions, for example, from slower manufacturing cycles or reduced electronics production, would further exacerbate downward pressure. In this scenario, silver would test previous support levels seen in the last 6 months, and margins in the physical market might compress, raising premiums temporarily as availability adjusts. This case does not predict catastrophic collapse, but illustrates a plausible outcome where multiple converging factors produce material downward movement, consistent with historical corrections in similar conditions. Key takeaways from the scenarios: each scenario is conditional. It starts with observable, historical, or confirmed data points. Movements in silver are not random. They respond to macro indicators, industrial demand, liquidity, and investor positioning. No scenario assumes certainty. Each is a framework for understanding risk, not a forecast. Professionals monitor indicators, analyze correlations, and anticipate probable outcomes without claiming control over markets. By framing silver's near-term path in probabilistic terms, viewers can see that risk and opportunity coexist, and that outcomes depend on interactions between multiple measurable variables. This approach encourages disciplined decision-making rather than emotional reaction. When I look at silver, I start with the obvious: price charts. But the real story is in the underlying data. The US dollar index, DXY, is a primary driver. If the dollar strengthens, silver tends to face downward pressure, simply because it becomes more expensive in other currencies. Conversely, if the dollar softens, demand for silver can rise internationally. Watching the DXY daily, noting spikes or sustained trends, provides context for price movement beyond headlines. Next, Treasury yields, especially the 10-year and 2-year rates, signal opportunity cost. Silver doesn't pay interest. If yields rise, investors may shift capital toward income-bearing assets, which can dampen silver demand. Drops in yields often coincide with renewed interest in non-yielding stores of value. Tracking yields alongside silver positions gives a real-time sense of investor trade-offs. Inflation measures are equally important. I monitor both CPI and PCE data. Monthly releases, subtle trends, and surprises can shift sentiment. If inflation accelerates, silver may attract incremental buying as a hedge. If it moderates unexpectedly, that hedge demand can soften. Looking at these numbers in isolation isn't enough. It's the relationship to market expectations and the rate outlook that counts. Volume and liquidity provide another layer. High trading volume during price spikes or dips indicates real engagement, not thin market noise. Open interest in futures contracts highlights where leveraged positions are concentrated. Sudden changes in open interest can suggest either building pressure or a release of it. Finally, physical market demand matters. Premiums on bullion coins, Delivery times and inventory levels at major distributors show real-world engagement. ETF flows, measured weekly, reveal investor confidence in financial proxies for silver. By observing these indicators together, patterns emerge. It's less about predicting tomorrow and more about understanding the forces in play. Anyone following silver closely should track these metrics consistently. They reveal the pressures shaping price movement, helping differentiate between a temporary wobble and a structural shift. Silver moves, sometimes quietly, sometimes in sudden bursts. The point isn't to predict every twist, but to understand what drives it, to recognize the chains of impact, and to measure risk thoughtfully. Holding silver isn't about chasing a number. It's about managing exposure and keeping perspective. Remember, no price floor is guaranteed. No strategy is bulletproof. What matters is preparation, patience, and clarity about why you own an asset in the first place. Monitoring the dollar, yields, inflation, volume, and physical demand helps you stay informed, not reactive. This isn't investment advice, it's simply how I'm reading the market right now. Focus on the indicators that matter. Understand the context. Keep risk manageable. And if you approach silver with discipline, the short-term swings become just background noise, while your long-term objectives remain intact.